How to pay off your mortgage early. Some homeowners are eager to pay off their mortgage early for various reasons, including reducing interest payments and removing the psychological burden of debt. Paying off a house loan early might help retirees boost their cash flow. It is beneficial when switching to a fixed income. You are paying off your early mortgage decreases the amount of interest you'll pay on loan, regardless of your motive. You can save a lot of money. Here are a few early payout techniques to assist you in achieving your objective. How overpaying works. You may overpay your mortgage in two ways: with a lump amount, such as money from an inheritance or a redundancy settlement, or by making additional monthly payments. Explains Chris O'Brien, Product Development Manager at NatWest. There may be restrictions on how much you may overpay in a given year in some circumstances, but O'Brien suggests checking with your bank to see what your overpayment choices are. 5 ways to pay off your mortgage early. Paying off your mortgage early can help you achieve financial security while also saving you money in the long run by reducing the amount of interest you pay. Here are some ideas for getting your mortgage paid off faster. Refinance your mortgage. If interest rates fall, you may be able to lower your interest payments by refinancing your mortgage. You might also choose to shorten the length of your loan drastically. Make extra mortgage payments. Making additional mortgage payments is another method to save money on interest while shortening the duration of your loan. Consider the following early mortgage payment methods if your lender does not impose a penalty for paying off your mortgage early. Just make sure to tell your lender that your excess payments should go toward the principal rather than the interest. Otherwise, your lender may add the funds to future planned monthly payments, resulting in no savings. Also, attempt to pay off the debt early on when the interest rate is the greatest. You may not know it, but the majority of your monthly payment for the first few years goes toward interest rather than principal. And interest is compounded, which means that the total amount owing determines the amount of interest charged each month, principal plus interest. Make one extra mortgage payment each year. Making an additional mortgage payment each year might drastically shorten the length of your debt. The most cost-effective method is to pay 1/12 more each month. For example, if you spend $975 every month on a $900 mortgage, you'll have paid the equivalent of an additional payment by the end of the year. Round up your mortgage payments. Rounding up is another technique to lower the term of your mortgage substantially. Pay $800 rather than $743 or $900 rather than $860. To the next most significant $100 number when budgeting for your mortgage payment. Try the $1 a month plan. If your salary rises slowly but steadily over time, the $1 a month plan should be financially doable. Increase your monthly payment by $1. Pay $900 for the first month, $901 for the second, and so on. On a $150,000 loan with a 30-year, $900 per month mortgage and a 6% fixed interest rate, you make up the duration of your mortgage by 8 years. Can you pay off your mortgage early? You may pay off your mortgage early without penalty in most circumstances, but there are a few things to consider before doing so. To begin, inquire with your loan servicer about if you includes a prepayment penalty. If it does, you'll be charged a fee if you pay off your loan ahead of time. This might have an impact on whether or not paying off your early is financially feasible for you. Second, check to see if there are any limitations on how and when you may make extra payments. Some loans include conditions that encourage you to stick to the payment schedule, and it's critical to make sure that any additional charges go toward the principal rather than interest. Should you pay off your mortgage early? Many factors influence whether you should pay off your mortgage early, including the interest rate on your existing loan and your risk tolerance. Consider the opportunity cost first. You're paying money into the when you might be using it for other financial goals if you pay off your early. Of course, you'll save money on interest, but you could get a better return if you put the additional payments toward anything else rather than your mortgage. On the other hand, making extra payments might be a smart option if you know you'll spend that extra money if you don't put it toward your mortgage. The peace of mind that comes with owning your house without a mortgage is something to think about. Read more. Consider how much cash you have on hand in case of an emergency. You don't want to keep all of your money in your house and cannot access it fast if you have a financial crisis. Finally, with mortgage rates so low, it's typically preferable to hold a low-rate mortgage today and invest your spare cash in the long term.